Hey everyone, welcome back to Airlines Quest. Today we're going to dive into the Biden administration's recent moves to scrutinize the use of corporate jets and increase taxes on private air travel. This has become a hot-button issue as the White House tries to get large corporations to pay their fair share in taxes. From the President's State of the Union address to comments by Treasury Secretary Janet Yellen, there's clearly an effort underway to rein in what they view as excessive tax breaks for corporate aviation. Why the focus on private jets? For years, they've been seen as symbols of wealth, luxury, and excess, from celebrities like Taylor Swift hopping on their private planes to wealthy executives using company jets for personal travel. Democrats argue the tax code is too generous with incentives that promote this type of air travel by the ultra-rich. At the same time, the corporate aviation industry is pushing back hard. They contend private planes are essential business tools that allow executives to easily travel to factories, offices, and meetings across the country. They view the proposals as unfairly targeting and undercutting an important American industry. So in this video, we're going to break down exactly what the Biden administration is proposing when it comes to corporate jets, the pros and cons being debated, and the larger tax policy implications. We'll look at the key pieces: raising taxes on jet fuel for private planes, eliminating accelerated depreciation tax breaks for corporate jets, the IRS cracking down on personal use of corporate jets. Let's start with the proposal to increase jet fuel taxes. One of the main proposals from the White House would raise the taxes paid on jet fuel for private planes and corporate jets over a 5-year period. Currently, the tax is just 21.8 cents per gallon, with that money going into the Airport and Airway Trust Fund to help finance investments in airports and air traffic control systems. The Biden administration argues this rate is far too low, especially considering that private jets account for 7% of flights handled by the FAA, but contribute less than 1% of the taxes paid into that fund. Their plan would increase the jet fuel tax rate to $1.06 per gallon by 2028. They frame this as a matter of fairness and leveling the playing field, having corporate jet owners pay their fair share to maintain the national airspace system that they're using, versus having commercial airlines shoulder more of that burden. The jet fuel tax hike is estimated to raise around $1 billion in new revenue over 10 years based on administration projections. Seems like a relatively small amount in the grand scheme of things, but every bit adds up as they look for sources to help pay for infrastructure investments and reduce deficits. Critics of the proposal, like the National Business Aviation Association, argue this move unfairly targets and burdens an important industry that relies heavily on fuel efficiency and mobility. They contend the current tax rate reflects the limited infrastructure needs of private aviation versus major commercial airline hubs. Additionally, some argue that dramatically raising taxes on jet fuel could inadvertently encourage more fuel trucking operations to service private planes and lead to other logistical hurdles. There's also the question of whether higher fuel taxes would truly change corporate behavior around private jet use. At the end of the day, while the revenue impact is modest, this jet fuel proposal aligns with the White House's broader goal of cracking down on perceived tax advantages for wealthy individuals and big corporations. It's making a symbolic statement about everyone paying their fair share, even for what some view as a luxury perk of corporate aviation. The other major part of Biden's corporate jet proposals deals with changing depreciation rules that allow companies to write off the cost of purchasing a new plane more quickly. This accelerated depreciation is viewed as a key tax incentive that promotes corporate investment in things like equipment and machinery, but the White House wants to get rid of this depreciation advantage specifically for corporate jets. Here's how it works currently. Under U.S. tax law, companies can deduct the full cost of a purchased plane over 5 years through accelerated depreciation. In contrast, airlines have to depreciate the cost of a commercial aircraft over 7 years using straight-line method. Why the difference? The argument has been that corporate aviation plays an important role in boosting productivity and economic growth. So there's a policy incentive to encourage businesses to invest in jets through this accelerated depreciation. However, the Biden administration is proposing to eliminate this depreciation benefit for corporate jets, requiring them to be depreciated over 7 years just like commercial planes. They estimate this change alone would raise around $3 billion in additional tax revenue over the next decade. In announcing this proposal, Treasury Secretary Janet Yellen criticized what she called corporate jet write-offs, framing them as an abuse or loophole that unfairly benefits the wealthy. The White House casts this as simply creating a level playing field by having private jets follow the same depreciation schedule as commercial aviation. But the corporate aviation industry sees it very differently. They believe accelerated depreciation has been in place for good reason, incentivizing companies to invest in planes that boost productivity, investment, and economic growth for the nation as a whole. Removing this benefit could slow orders and capital expenditures on new planes in their view. There's also the question of consistency. Why single out corporate jets versus all sorts of other assets that companies can write off over an accelerated schedule? The industry argues this could open the door to depreciation changes impacting more sectors in the future. More broadly, this depreciation proposal fits into the White House's narrative that corporations receive too many tax preferences and don't pay their fair share, but could potentially backfire if it means less investment and spending in an important U.S. manufacturing sector that supports many jobs. It's worth noting that corporate tax rates have declined significantly over the past few decades. So in that context, the White House argues that eliminating industry-specific incentives like accelerated depreciation is simply leveling the playing field and closing loopholes versus dramatically raising tax burdens. No matter where you stand, changing depreciation rules for corporate jets is a much more substantial revenue raiser than the proposed jet fuel tax. It's also a more complex policy debate weighing economic incentives against closing perceived loopholes benefiting the wealthy. In addition to those two legislative proposals around jet fuel taxes and depreciation, the IRS has also recently announced they'll be ramping up audits and enforcement scrutiny specifically focused on corporate jet owners and executives. This renewed focus by the IRS stems from the $80 billion in new funding they received as part of the Inflation Reduction Act to revamp technology and crack down on tax evasion by wealthy individuals and large corporations. Targeting corporate aviation appears to be one of their first major initiatives deploying that new staffing and tech infrastructure. Here's the basic issue the IRS aims to address. Under current tax rules, companies can deduct expenses related to operating and maintaining a corporate jet, but only if that jet is used exclusively for legitimate business purposes like transporting employees on company trips. However, the IRS believes there has been widespread abuse and underreporting happening, with companies potentially claiming millions in deductions for personal travel by executives, shareholders, and other wealthy individuals associated with the company. Maybe a CEO uses the corporate jet to fly their family on vacation, or perhaps a private contractor essentially gets free personal travel as a perk for doing business with a company. The concern is that in many of these personal travel scenarios, companies have allegedly still been claiming the full deduction for operating the jet as a business expense. On the flip side, those wealthy executives potentially failed to report and pay taxes on the personal travel as a form of taxable income or compensation. So the IRS believes there is lots of missing tax revenue here across both the corporate and individual taxpayer side of things. Exactly how much is unclear, but they estimate there are tens of thousands of corporate jets in the U.S. where this behavior has been happening frequently enough to represent substantial sums. To crack down, the IRS will ramp up audits targeting both the companies operating these corporate jets as well as auditing the wealthy individuals flying on them. They are getting access to thorough flight data analytics to trace travel patterns and personal usage. Auditors will be digging into maintenance costs, staffing expenses, and other factors to see if deductions were improperly claimed. On the individual side, the IRS will pursue taxes owed if they conclude personal jet travel counted as taxable income not properly reported. Backing up the audit push is the threat of considerable fines and penalties for tax evasion on these issues. The IRS very clearly wants to send a message to corporations and the ultra-wealthy that the personal usage of corporate jets won't be treated as a tax-free perk going forward. However, the audit initiative has drawn some skepticism and pushback even before it really gets off the ground. The corporate aviation industry argues their finance teams are extremely diligent about following applicable tax laws around usage and deductions. They claim there is no systematic abuse of magnitude envisioned by the IRS and dismiss it as the agency buying into unfair stereotypes of private jet users as wealthy tax cheats. Tax advisory firms have also questioned whether the audits will yield tens of billions in new revenue as the IRS projects. Their view is that most personal corporate jet travel is already being tracked, disclosed, and taxed properly versus widespread evasion. Additionally, given many executives travel almost exclusively on corporate planes out of necessity for their roles, There could be convoluted determinations over what constitutes legitimate business use versus personal travel that triggers extra taxes. So there are concerns the IRS could overstep and pursue taxes in circumstances where none are actually owed. Lastly, the new audit activity could create substantial administrative hassles and paperwork for corporations beyond just fines or back taxes, adding yet another tax compliance burden. So while the IRS is following the White House directive here to crack down in this area, the ultimate revenue impact will remain to be seen. And if the audits are not conducted prudently and based on clearly established standards, there could be backlash over government overreach and harassment of both corporations and wealthy taxpayers. That was all. Hope the issue was discussed in details for you to analyze it better. Don't forget to like and subscribe.